I was the most bullish guy in the whole country in the 1980s when this boom was just getting going, and people thought, oh, this was just a short-term thing. People thought Japan and Asia was going to take over the world and the US was dead. So I've been predicting the greatest boom in history, and you can't have the greatest boom in history without it coming down hard and strong and having a big crash. That's just the nature of markets. They go both ways. But what's happened uniquely here, the markets did peak in late 2007 when baby boomers were peaking in their spending curve all the way from 1983 to 2007. That is when people keep hitting age 46, their peak spending in higher numbers. And what happened in that crash in 2008 and 9 is the central banks panicked and they just said, well, we can't have a depression. And that's what it looked like. And that's what it would be like after such a great boom, just like the roaring 20s and in the early 30s and the Great Depression. And so they've been printing money ever since. And then when they hit COVID, they printed more money in the last year and a half or two than they printed in the 10 years before that. So we're in this basically confrontation between central banks desperately printing ever more money to keep us from shaking out the greatest bubble in financial assets in history, the greatest debt bubble in history, and now global more than any time in history. This is a big deal, but it's bearish only because we're coming out of the most bullish period in history. So it's not a bad story. We have to shake out these excesses, or the millennials will never be able to invest at reasonable rates, and the economy can't rebalance and prepare for the next boom. And again, I've been predicting the next boom forever would be the millennials from 2024 into 2037. Not as long as the baby boom and not as steep, but we will see another boom to follow this in the US and more so in Asia, especially India this time, in China and Southeast Asia. So there's more boom to come, but we have a major, this is going to be the biggest crash, the biggest downturn of your lifetime is what I'm saying. So first of all, I've studied every major bubble in history and the first crash. Now, I'm just saying the first crash, when the bubble finally gives, okay? Like in 1929, or in 2000, in May of 2000, when it first crashed. The first crash averages 46% in just 2.6 months. Now, when a major bubble of this magnitude, like 1929 or 2000 or now, crashes, the whole crash tends to be about 80 to 90%. 1929 was down 89%. In 2002 crash, the NASDAQ was down 78%. I'm saying stocks in general in this crash will be closer to the 29 to 32 crash. I'm estimating 87% for the S&P 500 and maybe slightly higher for the NASDAQ. And then we will have the buy opportunity in investments of a lifetime in around late 2023 or so. I predicted the 2007 top 20 years before it happened. That was a natural boom driven by real consumers and investors. You've got governments fighting this crash, and so it is impossible to predict. I am telling you, and I will stand by this, we are going to see, with unbelievable analysis in history of every bubble, major bubble in the last 150 years, that first crash will be so fast you will not see it. So if you wait to see if I'm right and take that risk, you are going to be hit very, very hard. And history is very clear about that. No exceptions to that. But if you don't listen to me now, you're taking the biggest risk of your life. Now you can make your own judgment. I have no problem with that. This is the hardest thing a person can possibly do, is fight a bubble, which every central bank is so committed to keep going that they will print $5 trillion. Yeah, $5 trillion been printed just since COVID by the Federal Reserve. That's what I'm fighting. But I'm telling you, if you think you can keep printing exponentially more money and keep a bubble going forever, then you have not studied history and you're the insane one. So I'm standing by my forecast. You got to weigh the risk versus the returns here. Every time this market goes up another 5 or 10%, the downside gets higher and the risk of the bubble bursting gets higher. But you're right, there is no way when a bubble is being orchestrated. It's one thing when it's a natural bubble, okay? When it's being orchestrated by central banks and they're fighting it, there's no way to predict it exactly. You can only squeeze so much juice out of a lemon. The economy is not responding. I mean, if $5 trillion in 2 years, we should be growing at 20% a year. So you get less and less as this escalates until basically the central banks lose the war. There is no way they win this war, because next time, if they printed $5 trillion since COVID, next time when we crash, they're gonna have to print $10 trillion. Where does it get so ridiculous that nobody has any faith in it anymore? And that's what makes it hard to predict. I'm saying I think we're there. That's just my opinion. You can ignore it all you want at your risk. By the way, the demographic trends, which I uniquely created that system, which caused the greatest boom in history in 2007, have been down from 2008 and do not bottom in demographic trends until late 2023. So we're fighting slowing natural trends in spending. You can see this two ways, that what the governments keep printing more until you get inflation out of control and you get like an inflationary blowout. I'm predicting that when stocks and financial assets start to crash and people start selling those, you're going to get deflation. Money gets destroyed. There are trillions and trillions and trillions of dollars been built up just in financial assets from this money printing. It hasn't caused the economy to be super strong. It's caused the biggest financial asset bubble in history. When people start selling those financial assets, wealth disappears and people panic more. And then that causes the recession. The financial asset crash actually triggers the recession, which is more what happened in the 2000 crash. First tech bubble burst, now second tech bubble, and bubble in real estate, second bubble in real estate, second bubble in gold. Everything is bubbled this time. So it's the financial asset bubble that triggers a recession, and then the recession makes the financial asset bubble crash more. There are always safe assets, it's just narrow. I'll tell you what the safest asset is, and this is true in the early 30s, as in 2008. Gold went up in the early part of that 2008 crash. And then when it got severe in Lehman Brothers, gold went down, everything crashed except for one thing, US Treasury bonds and AAA corporate bonds. So the bonds tend to react to the downturn. The safe bonds, only the Treasury bonds and the AAA corporates go up in value. Other bonds have risk of default going up in such a downturn, so they go down in value, and of course stocks go down the most, and real estate in between. So that's what happens. The Treasury bonds and the 30-year is the longest duration. I'm telling you, you can be in cash and preserve your assets while everything go down. That's good. If you want to do great, you buy the 30-year US Treasury bond, and that can go up 40 to 50%, and it did so in 2008. For example, and this downturn is going to be worse. I love Ray Dalio. He's making a huge mistake here. He has not studied these bubble crashes like I have all throughout history. Cash is good. Whatever you have, you pull your money out of the markets at the highest I'm telling you, the highest you're going to see stocks and real estate, maybe for the rest of your lifetime, okay? You're pulling it out at the top, and then everything goes down, and you rebuy with that cash. That's a great strategy. But if you put it in the Treasury bonds, they will be the one asset. Treasury and AAA corporates, the very safest long-term bonds, have proven, especially in the most recent crash, 2008, to go up 30, 40, maybe even 50%. So you're growing your money in the crash and then rebuying real estate and stocks at the lowest price of your lifetime. I know this sounds extreme. I don't like to be extreme, okay? I was bubble guy and everybody loved me when I'm always gonna go higher and higher. No, this is the reality. Greatest bubble in history, crash. Governments push it up totally artificially more than any time in history. This entire rally since 2009 has been 100% artificial. And now you gotta crash and shake out all that nonsense, and then you can reinvest again. Now, if you wanna sit and wait, sit and wait. I'm just telling you the reality of what history says. If I'm right and the biggest bubble in history is about to burst. I have no money in the markets right now or things like that, financial assets. Remember this sentence, one sentence, best house in a bad neighborhood. Remember that, it's just 5 words, okay? And this is what happened in 2008, this happened. US was in debt, US had problems, everybody else did, but the US dollar went up the most, held up and went up in the crash. The US Treasury bonds did the best because it's the best house in a bad neighborhood. We're still the strongest military power in the world, still the largest economy in the world. China is way more in debt and bubbled up than we are, and especially real estate. Average Chinese citizen has 75% of their net worth in real estate that's 2 to 3 times as overvalued as ours, and ours is overvalued. We're the best house in a bad neighborhood. Our demographic trends are still down, but Europe's are worse and never come back. Japan never comes back. China is the only emerging country in the world. I study this stuff, okay? Its demographic trends and spending have already peaked. They are aging faster than any emerging country in the world and faster than most developed countries, and nobody looks under the hood and sees that. China is largely done, and they have 22% minimum empty homes and buildings that only weigh down a crash and cause real estate to fall hard. The biggest real estate bust in the world will not be in the United States, it will be in China. And those people have 75% of their net worth in real estate. So imagine the pain there. This is what happens when a bubble bursts.